But first, let's get right to the market action. So joining us now is Schwab Senior Investment Strategist Kevin Gordon and Evans May Wealth Managing Partner Brooke May. It's great to have you both here. Kevin, you're sitting with us on set. I'm going to kick this conversation off with you as we do have 20K on the Nasdaq.
Yeah.
It is big tech that's really been leading the charge here recently, and it seems like we've seen the shift back into the leadership position for the biggest names in the market. Does that continue?
You know, it's interesting. It feels like this has been something that's been going on for a while. If you were to read, into the narrative and some of the feel out there and what's been reported, but really this has only been going on for just a couple of weeks. And I think what's been interesting is that from that mid-July peak for tech and tech-related, if you want to use the Mag 7 as sort of your barometer for that, since really the beginning of November, there hadn't really been any progress for that group. It took a while for them to get back to their prior, midsummer all-time high. At the time that was happening, the rest of the market had, a pretty significant rally, inclusive of industrials and financials, which I think were probably the poster children for that. So this has only been a phenomenon for, the past couple of weeks, but is emblematic of an environment that we think has been in place for a while, but probably persists going into 25, where you do get these really aggressive rotations into and out of sectors, even within groups like the Mag 7. What's really interesting is, even though it's been a great run recently for communication services and tech, the dominant performer in the Mag 7 over the past couple of weeks, really over the past month, has been Tesla. That's been a disproportionate, mover in that group. And you've had other names sort of down at the other end of the spectrum, being NVIDIA, which have been sort of the laggards. So you're not getting a sort of complete picture where every single company in a group like that is doing well. But we think those kinds of aggressive sort of rotations, either across groups or across sectors, but also within sectors, probably continues.
It's interesting too, because it's Tesla in the public markets, it's SpaceX in the private markets. Yeah. You could call Musk companies really the other Trump trade. But Brooke, the fact that we got CPI today, basically unchanged month over month, at least core CPI, but still stronger than the Fed would like to see. Mm-hmm. Markets 100% pricing in the fact that we get a cut next week. But how does this position us for 2025, especially as you do have stocks at all-time highs?
Mm-hmm. It is a little concerning because it's the fourth straight month that CPIs come in at 0.3%. And so we're looking at it a little bit more deeply and kind of peeling back the onion to see what are the culprits within that figure. And shelter's an issue. Shelter's up 4.7% year over year. And that factor doesn't affect everyone. However, food prices do. And food was up 0.4% month over month. So we're looking at CPI, and we know that if individuals can go to the grocery store and at the cash register feel a little relief, sentiment is going to improve.
Okay, Kevin, taking a step back, looking at 25 now, which do you think is a more convincing theme for investors to focus on? The overall good position of the U.S. economy, U.S. innovation, or the high valuation of the S&P, stubbornness of inflation?
Oh, can I answer both? I would say both, in the sense that, it is a remarkably unique environment where you do have relatively strong economic momentum, but also market momentum heading into 25. But you also have the potential for some pretty significant disruption from a volatility backdrop perspective from everything coming out of Washington in terms of policy, whether it's related to tariffs, whether it's related to immigration. But from a valuation and a sentiment perspective, we do think that's probably the biggest risk right now to the market. And across many metrics, you could look at price to sales, price to earnings, both forward and trailing. We like to look at a 5-year normalized PE, which takes 4.5 years of trailing earnings, but also takes 2 quarters looking ahead, gives you a nice blended rate for earnings. And if you use that as your earnings metric and put the S&P's price over it, you get to levels that you really haven't seen or have only seen in 2021 in the late 1990s. So automatically, that would probably, it's human nature to think, okay, pretty bad periods for the market after that, in those 2 time frames. But there is still, number one, room probably for multiples to expand a little bit more if you still have a lot of optimism and a lot of strength in the U.S. market. And number two, stretched valuation and stretched sentiment is never a reason that the market just turns lower and rolls over. You need some sort of, negative catalyst to tip you in that direction. We would argue it's probably something policy related, but you can stay in that exuberant or euphoric territory for a pretty long time.